All right. Welcome, everybody, to the Wealth Boutique Summer Series, where we are focusing on four different educational pieces on investment, taxes, and tools that help us implement the different parts of our practice. Kind of a behind the scenes look at what we do here at the Wealth Boutique. I'm Jessica Weaver. I am Wealth Advisor and founder of the Wealth Boutique. We are an independent RIA. We have the pleasure of working with AssetMarkt for various parts of our business and helping our clients and serve them. We have some clients on the call today too. Great to see. Today's a topic, private credits. It's been in the news a lot earlier this year. I feel there's a lack of knowledge and education around what private credit is, what it looks like, and how does it fit into your overall portfolio? How can this work for your money? What are some of the restrictions around it? How is it different than the typical investments that we see everywhere else? We have with us Noah Sanders. He comes from the private credit space, so he is a perfect guy to be talking to us and educating us on private credit. So I'm going to hand it over to you, Noah. Thank you for being here with us and diving into private credits today.
Yeah, thank you. I'll preface that I get the luxury of working remote on Mondays. So if you guys hear a very loud dog, that would be my pug, who is just about 15 pounds running around like crazy. But nonetheless, yeah, thank you. I appreciate everyone for having me on. Um, Jess couldn't have said it any better. It's been in the news a lot, right? And when private markets are in the news, they tend to stay in the news for a bit and they tend to make all the headlines, whether that's Wall Street, Barron's, Alt News, Fox News, whatever you read or watch. Um, we'll tackle it in a couple different ways as Jess teed me up here. So essentially, what is private credit, right? How does it work in your portfolio? And then maybe some of the things to look out for, right? Maybe some of those restrictions, some of the things that we can do as individual investors, or you guys can do as individual investors to just accumulate more of that educational knowledge of doing your own due diligence, right? You're not going to be a master, but you can be deadly enough to have the conversation. So I'll go. You feel free to interrupt me as you please if you have any questions that pop up as I go through some of the material. I'm not necessarily going to share slides. I just kind of want to keep it informal if that's okay with you, Jess, and just kind of talk through it. Because there probably will be questions as they pop up. But generally, the private credit market, um, it's a very large market. And what I mean by that, I always preface, and Jess and Cami and Sarah have probably heard me say it before. There is an index in the United States that we call the Wilshire 3500 index, right? It's filled of basically some of the most the public companies in America and basically all of the public companies in America. There's actually not enough to fill the index as of today, right? So what you see now in the States and globally too, is you see some consolidation in the space, right? You see the Mag 7 dominate that you guys have seen as individual investors, especially the last few years. And what you're really starting to see is less public companies, right? It was cool. SpaceX went IPO this year, so did a couple other names. We might see a couple others in the next couple of years. But really, the idea is getting beyond the public space, right? Taking it to the next level, accessing a totally different array of companies. Um, for example, the total US credit market as of today, according to Apollo and some of the other larger providers in the space, it's about 51 trillion, which is very large in retrospect. And that's the total US credit market. 11 of that is essentially public space that you guys might be familiar with, such as the high yield bonds, the corporate bonds, the maybe more leverage bonds that might be treated more of a private credit or private vehicle. And then you have the 40 million of that 51 that's essentially the private space. And that private space consists of commercial real estate lending, industrial loans, private placements, asset-backed lending, and that's where we'll kind of tackle into what is all of that, right? Really all it is instead of buying a bond on the capital or the public markets that we have access to, typically a company will set up a fund or a managed fund. And what that looks like is essentially what you all as end investors end up investing into. And that cash is used to deploy, maybe some company projects, restructuring, maybe a real estate project, or maybe just to complement other borrowers and facilitate that capital. That's where it becomes interesting and more of a business mindset that the borrower who is facilitating that project, facilitating that real estate development, is the one who's essentially paying it back to the fund, right? So the fund is lending it to that borrower, right? And that's where you start to see some of the questions that pop up in the space and some of the headlines that don't do a great job of really deviating what the different types of private credit are. For example, you guys have probably seen some of the larger names this year, where they had maybe some defaults in the funds or the large withdrawals. And that's really because private credit isn't labeled as it should be. And what I mean by that is there's various different aspects of private credit. So there's direct lending to middle market companies, kind of what I was just mentioning. That's going to be your senior secured first lien debt, right? Senior being above that lesser debt in the capital stack. And then you're going to have maybe some, um, tendencies where you'll have less or the junk type of private credit facilitate alongside the senior secured debt. This can be thought of as you having US corporate bonds in your portfolio alongside high yield or those leverage bonds I was mentioning before. It's a great comparison. And I like to highlight the comparison because a lot of the headlines don't clarify that direct lending, which is the most popular form of private credit generation of capital right now, is secured. It is industrial grade credit. And that's where we really go into the next topic, right? And what that means for your portfolio. So, Jess in her job as an advisor and Sarah and Camille and their assistants and you is really looking for the best way for you as a client to meet your individual goals, right? One of the ways that they might do that is an income scenario. Private credit is generally used to amplify the income in your portfolio, right? And it's not necessarily there to replace your traditional fixed income. So it's not there to replace your treasuries or your corporate bonds or your high yields, rather complement them. And it does that a few different ways, right? You guys may have heard the story, diversification. It's always nice to have complementary goods. I like to think of this as the analogy maybe in the public space where you go out and you see a Walmart and you can go in and really buy anything, right? And you kind of get the discount. Back in the day, you used to actually tell the representative when you're checking out at Walmart that you could price match it from somewhere else, right? When they got really aggressive. And then now the private space is more of your Whole Foods, Trader Joe's approach where you'll go in and due diligence is required, right? They might want to get to know you. And what that really means is, hey, how much private credit makes sense for me alongside my traditional fixed income allocations, and maybe what that looks like and maybe why it's good for me. So the reasons being is going to be to amplify your income as an investor and the way that really happens, right? And you can always take a deeper dive, or I'll answer further questions, but the yield spread of what you're getting as a client in the public space is minimal. And what that means if I go out and capture a corporate bond compared to a high yield bond, that would be the credit spread in the public space. So the difference between those two numbers. In the private space, that's a lot larger. That means you have a lot more opportunity to maximize the income in your portfolio. And your question might be, well, what do I give up? The give up is liquidity, right? Generally in the private space. And that's a few different ways. So the way that we have it at AssetMarkt on our platform is going to be in the form of an interval fund, which is quarterly redemptions. It's a little bit different than maybe what you all have seen in the headlines with some of the larger companies as far as BDCs or business development companies and maybe some private preferreds and non-negotiable terms. The interval fund is a quarterly liquid package. So you're giving up, hey, daily liquidity through the market for quarterly liquidity, but then you're getting that higher residual or higher payment from the market, right? And that's really the idea. So capturing not only public and private exposure, but you're getting yield over different cycles, over different duration cycles. And it really is just an overall way to lessen the overall volatility in your portfolio, but provide for higher returns. And you tend to hear that a lot when diversification comes into the mix. However, it truly transpires in the private space because, we become so infatuated with how so easy it is to click nowadays and buy something at the click of a button in the public space that we often, figure out what else is out there. And that's the private space. And that hasn't truly been, the case over the course. I mean, it has in the course of history, but more than ever now, and this kind of takes me into my third point of what do we look out for in the space? Private equity has increased in 2025 by $8 trillion, just in 2025. It went from about 1 to 9 designated capital. And a lot of folks like to think about, well, where are they getting the money to do this? How are they doing this, especially with what's happening in the world, for a lack of a better way to put it. And it's driven by private credit. And now that's because, some companies and a lot of those private companies, right? A lot more private companies than public companies, going back to my original point, are looking for negotiable debt, right? They're looking for a manager that they can negotiate with on a few different things. That's either payment, right? The duration of the loan or what they're looking for. It could be a little bit flexible in nature. And then usually the structure of those both, right? And how it becomes to life and really how they get their money back as an investment manager and how the borrower is effectively met as well. And that's where we're starting to see a shift in the private credit space that you may all be familiar with now, especially with what we start at the start of the year, is tightening standards in the private credit space. And that's why you're starting to see platforms such as AssetMarkt, for example, really only hold a few managers on platform and, helping out maybe the Women's Wealth Boutique in assistance with, hey, we need to make sure we have those right managers on platform so we don't have issues occur that has had in the private credit space. Some of them are unstoppable, right? Some of those are going to come to fruition, right? Some of those large withdrawal requests for the private credit funds. Um, Unfortunately, a lot of those are, driven by extraneous measures, and I'd be happy to hit on those if anybody has any questions. But really, in the space now, to kind of conclude and recap is, hey, we want to make sure that we're getting broad exposure, and that's going to be through a few different ways. On the equity side, you'll have that piece. On the fixed income, you'll have that side. And then now we need to rethink about the portfolio as that third piece. And that's really the private credit piece, especially if minimums apply, right? I didn't hit on that. Usually these are generally higher minimums. The good thing about some of the private credit vehicles you see out there now is they're lower minimums due to the structure they're in. It used to be a lot harder for individual investors, such as anybody on this call, to get access to private assets as they were tied up in endowments, private pension plans, and really exclusively 30 to 40% of those plans allowed for that. So the access is there now, to recap. So you have the access as the individual investor. You're going to get really generally increased income and less volatility in the portfolio. So that means generally better performance for you, less volatility. And really the last thing I think that's important is that once again, as we move forward and tightening of crediting standards moves forward, we're in a different market with disciplined underwriting than we've been in. And I think we'll start to see that open up more as more and more individual investors do look for access of private instruments because it is few right now. And the good thing is you're ahead of the curve. But it means when you're ahead of the curve that generally there's going to be some rocky bumps. So with that, I'll kind of leave it off at the 15 minutes and I'll take any questions that come to your guys' mind. Oh, I think you're muted, Jess.
I am muted. Thank you so much for going into that. I would love to hear the due diligence process at AssetMark for bringing on, because you mentioned we are very selective in which ones we're going to bring on, ones that have a long track record,
Mhm.
haven't gone through some of the other hiccups other funds have. So what does that due diligence process look like?
Yeah, it's funny. So we have calls quite often, and they're internal calls. This is aside from due diligence. This is extra due diligence for everyone. So, for example, today we had a call, and it was more really about the strategies on platform, and it's always a required call on the investment side, right? We want to make sure the whole firm is there. Due diligence for us at AssetMark is everything. We have a team and you guys can look them up, but it's really led by Zoe Brunson, who has been a renowned leader, not only in the women's space, but just overall the due diligence space in general in the industry. She's won several awards. On average, to even get considered at AssetMark as part of the due diligence process, your weight as an investment manager, and folks, that's people that you can think of that are very large, like Goldman Sachs and some of the other big names. It's on average 3 years to even get considered as part of the investment lineup at AssetMark. And that's inclusive of the private space, right? We took some time getting into it, and we knew that it was important for us because not only advisors wanted access, their end investors wanted access because it was important for a lot of the reasons I was mentioning. That process, for example, a lot of investment managers have opted out of because it is so rigorous for us as a firm. A lot of investment platforms out there similar to AssetMark have vast number of managers, both in the public and private space. and they tend to can't keep up with our due diligence process. What that process really looks like is a 10-step initial due diligence review with that investment manager or firm. And inclusive of that, I think the packet right now to be filled out and sent back to AssetMarkt is almost 667 pages as far as the investment manager goes. So it's a very large process that tends to start with that, and it gives you a good idea of how long it can actually run throughout the process. Now, in addition to that, that's the start. The pending reviews that we do are going to be quarterly, sometimes monthly with the manager. Lately, it's been quarterly with private assets and sometimes even semi-annually with some of the public managers. What that looks like is, hey, has the team changed over at the other firm? As simple as maybe one research associate on the team that provides a different type of view, right? In the investment selection process. Another way could be, has this team recently worked with any other investment platforms to have a deal on it? If so, what is their angle? And the third thing is, hey, how has performance been in this fund, or are they meeting expectations? For example, on the private side, that might be, um, has there been any necessary defaults that we need to pay attention in the portfolio? So a bond, somebody not being able to meet the obligation on their bond in the fund.
Awesome. Thank you. And how about opportunities? I know one of the things that was in the headlines earlier this year was about it's too much exposure to software and the AI trade. What opportunities do you see in the private space right now?
Yes, and it's a great one, and people are having this discussion as you guys, and I could talk for hours. Jess knows this, but um, it's very similar to the high yield space, but going back to the spread difference of what you're getting, because the public spreads have to give a lot lower. As you guys may know, for the folks on the call, I live in Chicago. So if you drive about an hour east of here or an hour south of here, an hour east is the Indiana border, right? I have a house on the Indiana border, and we it's for my mom. So we bought my mom a house on the Indiana border. I took a ride to her house not too long ago, and you see no data centers everywhere, no data center signs everywhere, right? In the local neighborhood. And that's there's some controversy around that, but really what I'm getting to is a lot of these private credit opportunities are around the energy space right now, and explicitly with this type of development, right? That's going to be the data centers, that's going to be AI tech innovation. You are seeing a lot more stringe away from it from the public side because those companies, once again, Jess, are looking for those negotiable terms that can actually be driven out over a long period of time where the public market can't afford that. Some of the other opportunities in the industry right now are going to be some of those smaller tech firms, right? We go back to the Mag 7, we go back to a lot of the names being, hey, it's going to be either tech or maybe some medicine that really drew up some of the companies as far as this year is the medical fields. And really what that is, hey, how do we get that same type of exposure that was once in the large cap, mid cap, small cap space on a public side, but do that on a private side because they are there. They just don't they just don't make the headlines every day like you expect they do. And that's really where a lot of these loans are coming from. So I think what you're starting to see is tightening stricting standards that I was talking about earlier, which is going to help with this. It's going to allow for less defaults, faster recovery. The recovery is how fast the investment manager is paid back upon the default, so faster recoveries. And then I think what we'll start to see is we'll start to see a lot more smaller companies have more negotiable deals, especially as tightening credit standards apply. And I think we'll explicitly see that in the next 5 to 7 years over the energy space.
Awesome. Thank you, Noah. Those are my questions. And anybody else have any questions or they want to put them in the chat? Lord, too interesting. 3-year due diligence process to even be considered. 10-step process. 0.2 with the broad exposure, 3 pieces. We have stocks, we have bonds, and now we have the private space as well, being uncorrelated for them too, which is nice diversification
Yeah.
as well.
Linda, I saw you come off mute. I'd be happy to address anything.
Yeah, well, this is Linda's husband,
Yeah.
Al.
Hey, Al.
Hi, Jess.
Hi, Al, how are you?
Okay. Um, I connected in a little bit late. I ran off to tell Linda what was on, so I missed maybe 5 minutes of the very beginning. But
Yeah.
um, how are the you mentioned these vehicles are used primarily for like income purposes, right?
hmm
a generator. So then for tax implications, or how are they treated? As like dividends or ordinary dividends, exempt
It's
dividends,
it's
whatever.
a good question. So it's treated as return of capital for
Ah,
you.
okay.
Um, are you familiar with return of capital, Al?
Vaguely.
So it's necessarily a benefit you as the individual investor as far as tax purposes. Um, I can't go too far into that without knowing your story, maybe as Jess would, as far as what that fits as far as what you look like in the bracket, etc. But necessarily it is a benefit compared to like your traditional dividend payment.
Okay. Um, and then the other you mentioned that like every other investment, there's like risk levels, right?
Yes, yeah.
So that's something that we would work with, like Jess, to try to pick out a fund, I guess you call them,
Yeah,
right?
that is correct. We have a few on platform right now. Hey Al, good to see you.
Hi.
Um, yeah, so we do have a few on platform, for example, and that would be really figuring out one, how much exposure you wanted towards that. If you were meeting some t
Mhm.
type of goal, I won't steal Jess's thunder here. And then yeah, maybe Jess would work with someone like us to actually implement how much would be necessary as far as what you were looking for. Was Al looking for how much money as far as their initial investment, right? And going from there. So looking backwards and just making sure, you know, it fits your need.
And you also said traditionally the amounts were rather high, right? But they're coming down, right?
Correct.
So what do you mean by down?
That's a good question. That's a very good question.
How many
Traditionally,
zeros?
a lot of zeros. So I'll give you zeros. It's, it basically in the industry, and it came down over time, but now you're sitting at some of these funds like we have on platform that can go as little as like 10,000. And before to even get access to like your premier private market space, and generally that would be through a hedge fund equity provider, right? That would be 1 million. So you're a few zeros, down from 1 million
Okay.
to 10,000.
Okay. All right. Well, that's all I had at the moment.
Yeah. And the important thing to think about there, Al, is of course, with anything, the more money you have put to work, the more results you can expect.
Yeah.
And I think
Right.
that's really just where the nice thing about having minimums lowered in the industry is not just someone saying, hey, this is better because it draws more income, but how much can I put towards this that I wouldn't have had before because the minimum is lower. So now I can do maybe different allocations, right? I can put that 10,000 towards it and towards something else as well. Whereas before, you know, maybe that was all the money that person
Right.
had, and they had to
Right.
make that decision. So,
Right.
yeah, great
Right.
questions. Thanks for
Okay.
hopping on.
Okay.
Good questions, Al. Good to see you.
Yeah.
And it's you're looking at where does this fit into the overall portfolio? Usually it's not the whole portfolio, but a sleeve of
Right.
it.
Right.
And to Noah's point, you can back into it to see how much income do we want. We have clients getting several $100s, $1,000, more than that a month just from the yield, not even
Right.
touching the principal, which is really nice.
Right. Right.
Yeah,
And
and that's really the whole goal too, because they don't want to jeopardize the integrity of Al's portfolio just by implementing one type of asset class that might be new.
Hmm.
And it's been great when we had the pullbacks from the tariffs last year and then also from the Middle East crisis this year. The NAV is steady. It's pretty steady. It doesn't move much at all. So it's nice to have something that's not correlated when we
Oh.
do have those pullbacks and you're just getting that income along the
Right.
way. So
Right.
it's
Right.
been a
And
nice tool.
is that income that's not locked in for any particular period of time though, right? That's like variable.
Your income, yeah, you can take that as distribution or it can get reinvested,
Uh-huh.
depending on where people are. So we have retirees that are taking it as income, and we have people who aren't retired and they want it to keep getting reinvested back into it. Or the principal, or if it gets reinvested back into it, that's that 3 month lockup period, the quarterly distribution or liquidity
Okay.
we talked about. Mm-hmm.
Yeah.
Mm-hmm.
Okay. Okay.
Question.
And that's a great point, Al, that you hit on. It is variable. The investments tend to be SOFR plus that agreed upon variable rate. So SOFR is the overnight lending rate, and that would be plus that amount. Generally, the funds, for example, on platform here and in the private credit space tend to fall or tend to above that 7.5%, 8% yield range. And then that's where you start to think about how that looks for you on a taxable adjusted basis, et cetera, or yeah, or non-taxable. And I think really the idea there is um, that's why you actually I could hit on that all day, but that's actually why you operate in a vehicle like a private credit vehicle. It doesn't have daily changing in the NAV. To Jess's point, it operates on a quarterly basis, and what that allows for the company to do is they don't need to operate by the public way to showcase things. They get to really, if you get to ever take a look at some of these books, they operate on their own model cycle of how they provide those, right? Because they have so many deals under that one fund that could exist that it would be necessarily almost impossible for them to show what that looks like on a daily NAV. So that's actually a benefit, and that's why you see less volatility.
So in comparison to
hmm
some EFT, maybe on you mentioned before the AI, right? Or a chip EFT, right? ETF
hmm
rather.
Yeah,
You said their payouts, if you want to call it, are considerably higher than those.
correct. Yeah, and that's why you see it passed down to the end investor, right? Basically, the deal they have on the private side as far as that borrower, so the person asking the investor fund to
Mhm.
borrow for that specific project, they're looking for something negotiable. If they weren't, Al, they'd go to the public market to source that bond or to source that way to generate capital or that
Mhm.
loan, right? That depending on the project, if it may have been a municipal bond they were looking to generate, if it was local and they were looking to rebuild something local, or they might look for a different negotiable term. And that's where the private space comes in. With that negotiable term, the investment manager, a lot of the big names out there like Ares and KKR and Blue Owl, they get to say, hey, since we are meeting you halfway with this negotiable term, we want to make sure, we're compensated for that. And that's where that excess alpha from your traditional bond or bond ETF or energy bond ETF is going to come through the private space to pass that down to Al and Linda. That way they do have extra come in their portfolio. That's generally high level. Actually, that's what you missed for the first 5 minutes, Al. So I'll give you some leeway there of what you missed. But that's the general idea as far as how it's actually passed down to the end client and
Right,
why, right? Why the private space is able to pay more than the public space. Al,
right,
I was saying at the start of the call, we've seen the number of U.S. companies drop dramatically in the United States, right? There's a lot
Mhm.
fewer. It was nice to see SpaceX and a few other names go IPO this year. It's a decent IPO market right now, and hopefully we'll start to see that. But the private space, when you're talking in terms of the numbers of companies available compared to the public space, is vast larger. And this is why you start to see a lot of these more deals come to play because they're not able to match what the public market is giving. They are looking for some negotiability. Um,
Right, right.
so that's where you start to see that difference of why
Hmm.
you're able to capture more.
And that's why you said you find them in the hedge fund area.
That's where before you would have to access a lot of
Oh,
these assets. Yeah.
okay.
That's so the good thing is the industry's changed in the regards, and you may have seen this lately on the news the last 5 or 6 years, especially during COVID when they knew everyone was home. I don't know if you guys have noticed, they started to blast a lot more of this. They knew we were all home watching.
Yeah.
Um, and that's where you start to see the deviation move from, hey, I have to be a large pension manager, hedge fund manager, ultra high net worth client to even have access to the private space. And now there's different ways to do it. And some of the ways to do it are some of the funds that we have on platform and some others as well.
Hmm. Okay. It's interesting.
Thank you.
Yeah. Thank you.
Yeah, thank you. Where are you guys from, Al? Are you local to Jess and them over there or?
Yeah. North of her. Yeah. We're
Oh,
in
okay.
Northern Jersey,
Okay.
northwest corner.
Awesome.
with a data center.
Yeah. Yeah.
Oh, so
You mentioned data center. We just
yeah,
we just kicked out a data center in our town.
you're starting to see it. And the good thing is you guys actually got on it before, like, so you actually could. Do you mind if I ask, did you vote against it?
We were against it.
Yeah.
You see,
Yeah.
our town is a small rural town.
Yeah.
We have no municipal water service, right? We sit on our own aquifer,
Okay.
right? And our electric service is pretty poor anyway, right? So that was two immediate strikes that basically the whole town said, hell no.
That,
You know,
that absolutely makes sense.
we have enough problems of our own, right? So, once an entity comes into your town, shenanigans start happening, and what they said they would only do A, and then they eventually do A, B, and C also, and that further loads down. So that was a non-starter once they caught wind of that, you know. So
That
and
makes sense. Yeah.
yeah, that stuff, these small towns like ours, right? It's like it's small town business, right? We we think we're going one way, but then the people don't go ahead and do their homework,
Yeah.
right? Well enough to understand what the implications are, and then as more and more people start hearing about it, they raise hell about it, and
Yeah.
luckily they were able to change the town ordinance before an actual bid came in for the
We're
land
still
use
getting
board.
sued.
So but we're still getting sued by that company that was coming in, had some intentions to. So we're the battle's not over yet.
Still fighting it. It's good though. That's exactly what's kind of occurring. I don't know if you missed it, but yeah, for my mom, so we have her house in Indiana,
Right.
same type of community. It's a town called Hobart, Indiana, it's small. And you have the same type of thing going on there. So
Mhm.
I appreciate you sharing that. And we can always remember that if you look to be in this type of asset, maybe we can, ensure you don't have any
Yeah.
exposure to anything like
I mean,
that.
Good point, Noah.
Yeah.
I'm not adverse for it. I understand it.
Hmm.
I understand the power requirements behind, the AI and data banks and whatnot. It's just that it's got to be implemented correctly.
Mhm.
You know,
Agreed. Yeah, I
and
can't compromise the aquifer for you
yeah,
guys.
no,
Yeah,
And the noise.
yeah,
yeah.
and noise, right, right, yeah, and that was the other part. This
Strike
thing
three.
sits in a valley, and there's hillsides on either side of this potential entity, and sound travels up. It goes like a funnel, and
Does,
those
yeah.
poor people on the hillside, they'd be blown out of their houses. By what at roadside sounds like a low hum, but up a
The sound
couple
waves
hundred
travel.
feet on the mountainside, it's going to sound like they're in a wind tunnel.
Mhm.
So yeah, just
Thank you.
yeah, but thank
No,
you.
yeah. Yeah, thank you for sharing. That's good because you are starting to see it. I drive a lot and the amount you actually see compared to what you see on the news and you start to see it in person, how large these projects actually are.
Yeah.
It's fascinating. So yeah, we
But
could definitely we need to do a better job as a country to make sure we place them in the correct
Right.
areas
right.
without compromising towns that have been there for
And one of the
centuries.
local, just one last point, one of the local gentlemen not in my town, but in the next town, he owns a company called Planet Network.
Okay.
It's a fiber optic internet company, right? And it's a growing company, right? But he brought out a point that kind of got the attention of the land use board as well as the township committee. He says, "Be careful what you're trying to do," right? He says, "You realize that." These data banks are that's just like a generic topic. He says if you say none of that, right, you realize that your infrastructure in your town for high speed communications will be what you see today is what you'll get tomorrow and forever. He says you already have 20 of these data centers in your township, right? And it's for the landlines. There's a switching station. That's a data center, right? There's ones for cable television.
Cable, your
That's
internet. Yeah.
cable and internet. You know, uh, those are technically data centers. They're very small, right? And you don't even know they're there, right? And but if you say none are allowed, they're not included anymore, or they are included, and they can't grow. So your services will be lousy, in the future. But so
There's trade-off.
it's that old adage: be careful what you ask for.
Right.
Agreed. Yes. Yeah. It's you're wise to already consider that. Yeah, that's
yeah. Sorry to digress.
No, thank
Sorry,
you.
Jessica.
A timely tangent, though, because we are seeing this more and more. And the videos, I haven't seen them in person, but the videos, they're massive.
Yeah.
Massive what they're building. And they're
Yeah.
community
Keep them in
research.
Texas.
Yes.
I just moved back from Dallas out to the Chicagoland area. So, and now you may know if you see anything Chicago news related, we're debating on getting rid of the parking, because everywhere you go in Chicago, you have to pay a fortune to park. So we're trying to figure out if we're going to get rid of the extra meters they put in. Then if we get rid of them, then we get sued. So
Yeah. Yeah.
All right. Well, thank you all very much for joining us. Thank you, Noah, for taking us into private credit. Obviously, this is the conversation starter. There's more to go into and see how it fits into a portfolio. But appreciate you, Noah. This wraps up our 4-part summer series where we talked everything from the tax management, service overlay, securities-backed line of credit, donor advised funds, and now we had private credit. So this was a great series. Trying to do this every year where we bring different educational pieces to the forefront. So thank you all for joining us. We'll get this out to
thank you.
everybody.
It's nice to see you guys.
Thank you. Bye now.
Thank you. Bye.